Today on INI9, I have my good friend Mohit Satyanand from New Delhi, and we're going to discuss about the stock markets, why it is where it is, and so on and so forth. So, Mohit, what do you think? What's going on? Why is the stock market behaving the way it is, and what do you think is going to happen in the medium term?
Nitin, I'd actually turn that question on its head and ask why the stock markets behaved the way they did for the last 4 years and why they weren't recognizing the reality, which is that the Indian economy was slowing down. I look at stock markets from two perspectives. One is that of an investor. As an investor, I look at stock markets from the point of view of the individual company and operation, but I also look at markets from the viewpoint of a macroeconomist. And from that second viewpoint, which I gather is probably more relevant to your viewers and to INI, I think that the Indian markets and the Indian polity were suffering from a huge hangover, which was a hangover of the glorious growth years from 2003 to 2007, and that they had taken this new Indian rate of growth of 10%, 9% as something for granted.
Like a birthright.
Rates of growth like that don't happen automatically. They're nobody's birthright. They have to be earned by a huge amount of work on the ground. And on Indian ground, which is still classified as being 132nd, if I remember my number right, for ease of doing business, then the amount of work that needs to be done on the ground is massive, and we haven't even begun. And what we were really seeing between 2003 and 2007 was the functioning of a capital short economy in a global environment where capital was easy. And we saw interest rates which we'd never seen before. When we saw interest rates, one has to refer to an interest rate because interest rates are always a spectrum. So if you look at the 10-year bond yields in 2003 were lower than we've ever seen in our lives. And that was a great signal for a macroeconomist to say, hey, we're going to have a boom run.
Right.
And speaking for myself as an investor, on April 1st, 2003, I moved all family resources out of every other asset class and moved them into equities because this was a sign that the bull run was around the corner. The bull run lasted from 2003 to 2007. And I remember writing in May 2007, this is the end of the GIBR, an acronym for the Great Indian Bull Run. I was a little bit early, but I'd rather be early than late. And we saw the crash in January 2008. The crash would have lasted a lot longer, except for two factors. The first was the action of the Great White Chief, Bernanke, in the US, making huge amounts of cash available to delinquent banks, whether in the US or in Europe, which of course fueled resurgence of worldwide liquidity, some of which came to India. And hope for this great bull run in all asset classes was resumed. We, of course, by then had absorbed this huge mantra of the new Indian rate of growth, and we sold it to ourselves, and therefore we saw this great resurgence. So, but from my point of view, what happened between 2007 and, or rather, let's say from the middle of 2008 until late 2010 was a great big illusion that the Indian rate of growth was here to stay. It was not. As I said, we've seen precious little by way of reforms. Speaking as an entrepreneur and someone who advises the companies, it has not become any easier to do business in India. It has, if anything, become more difficult because of the fact that now we have this added uncertainty of which direction the policy environment is shifting in. Is it going to be a more enabling one, or is it going to be a less enabling one? As our politicians strive to gain some kind of legitimacy, how far back into the past are they going to reach to try and award penalties to businessmen? Partly, I think that is much needed. And I'm no apologist for businessmen who get seduced by a licentious environment. But partly, one also has to see it as a political move to try and deflect attention from the corruption and the inefficiencies of the state.
Right.
So this is creating an environment of huge uncertainty, and this is not the kind of environment in which businessmen want to pledge large sums of their money. So we now have a situation where, added to the global uncertainty about the value of assets, you also have this increasing uncertainty about the direction in which India is headed. Is the discourse pro-business or anti-business? Even within the UPA, leave alone within the larger polity. So you have the BJP, for example, who were pro-FDI when they were in power, now being anti-FDI in India. You have, A, you don't know which way is the UPA thinking, B, you don't know which way is the opposition thinking.
Right. So the entire narrative has changed, and it's no more a narrative which we used to see in the early part of the decade, where it was talking about growth, about liberalization, second generation reforms and all that. And now it's an entirely confused narrative where we have a bunch of people talking about inclusive growth and all sorts of huge spending measures. And you have another set of people who, being in the opposition, somehow feel that espousing something like reforms is not going to be a vote winner.
That's right, absolutely right.
Okay, now let me just pick it up from there. See, when is the falling stock market? When is it going to start affecting people who are middle class wage earners?
That's a difficult one, Nitin, because the most direct transmission that typically happens in a capitalist economy is through the wealth effect. So when you have stock markets going down, people feel less rich and therefore they spend less of the money. That is not a major transmission mechanism in India, because only 5% of our households own equities. So the major transmission, I think, will be more long-term, in the sense that it certainly, what was happening in 2003, 2007 was that for the first time in India, you had large numbers of entrepreneurs who were able to do what is part of a capitalist system, where you can use your own equity as currency. So when your share price goes up, it becomes easier to raise currency, to raise capital. So the impact through that is actually going to be very significant. So the wealth effect is not going to be there through the individual, but the wealth effect through the ability of companies to raise cash is going to be significant.
And therefore expand and therefore hire more people and do all kinds of things. That's going to be. So in that sense, it's a much...
The third impact, if I may add, the third impact is that because the fall in the stock market has been accompanied by, and to some extent due to, the drop in the value of the rupee, now you have uncertainty on a third score, which is the ability to raise money via foreign capital. Because, again, what we saw in those years was a lot of raising of foreign capital. And when you see the rupee drop from 44 to 54, and you have not hedged your borrowings, then suddenly you're faced with much, much higher cost of capital than you had budgeted for. And this is going to cause you to question your whole capital raising mechanism.
So thanks, Mohit. Dark clouds, in one way, and my own guess is that these dark clouds are nothing. These, to the extent that they're caused by policy, they can also be, moved away by policy or blown away by policy. So I would want to be optimistic about this.
Well, yeah.
What do you think?
Yeah, well, the only thing I would say there, Nitin, is that one of the rules I think of Indian eco-politics is that you don't see a change in policy till you see a crisis.
Right.
And Manmohan Singh's move to allow FDI in retail seemed to be a response to an emerging crisis, but the rest of the polity has not responded. So I guess we need to see a much deeper crisis before they also decide that some move needs to be taken.
Okay, here we are, a bunch of people wishing for a crisis. On that note, we'll end this little conversation. Thanks, Mohit, for being with us.
Welcome, Nitin. Pleasure.